No, not so far. Okay, great. Right, so handing you over to Tom Williams. Tom?
7 minutes. Yeah, hi everybody. Tom Williams. Thank you, Peter. Thank you, Rita. Yeah, okay, sitting here. It's getting cold outside now. We've got the old central heating going to warm everybody up. And we're all cozy here, having a nice cup of tea while we're talking to you. Now, the chart I have up, there's no reason why I have this particular chart up. It's just one that I clicked on. It's a 7-minute chart of the S&P future. And there's not a lot happening, quite honest, that I can see. But on this chart here, if you look over here, which is only not long ago, that is what we call a sign of weakness. What does it say, Pete? Right. It is definitely an upthrust. Look, it looks like an upthrust. It smells like an upthrust. It tastes like an upthrust. It's been rammed up. That catch it stops misleads as many traders as possible to wrong foot them, to turn around and collapse on the low. But in actual fact, that's just a general sign of weakness. And that means that that's the reason why the market has moved sideways 1, 2, 3, 5 bars since that event happened. Now it's a 7-minute chart, so wasn't all that long ago. So you should learn to recognize. Once you get an up move like this, once you see an up move behind you, the vulnerability of one or more professional people are getting nervous and they decide to start cashing in perhaps. Now, they don't all do it all at the same time, but somebody did. Now, there's not a lot of volume there, admittedly, but it takes weakness to do that. And the fact is they marked it up to collapse on the low like that after you see an up move is a general sign of weakness. But it's not definitely a sign of a top or anything. Now, this index is persistently insisting on crawling up. Day after day, we keep seeing it crawling up. And now I'm trying to describe what the end of a market might look like. And this is a build-up to an end of a rising market. It has to be. And eventually, we are now, at the moment, oversold. Or overbought. I keep getting them mixed up. Overbought, the top. Right? And you're vulnerable to professional money. They would appear to me to be distributing, at the same time holding the market up. But I've, in a newsletter, I'm sorry we couldn't do one last week because Rita was hijacked by some lawyers to do some typing for them. So we're unable to do it, I'm afraid. But the week before, I think we described typically what a buying climax will look like. And what will happen is it'll suddenly start shooting up. Right? And news will be really, really good. The end of the recession's over. Everybody's happy. Everybody's making money. Everybody's no problems anywhere. Now, what this tends to do, because you're affecting the herd, now the herd may already have holdings in this market. But because of the rapid uprising and the good news and one thing and another, they will also, and this includes banks, are liable to rush in and buy more. And then when you see these violent up moves, possibly widespread up into fresh high ground, closing in the middle with massive volume, that could very well be the buying climax, the top of the market. That could very, very well happen. It could also happen with what we call the end of a rising market. A similar story, but this time they mark it up. They gap it up into fresh high ground, and you see the spread to be very narrow. The volume will be massive, and we call that the end of a rising market. You guarantee they're the tops. And you certainly don't want to be long when you see either two of those scenarios I've just mentioned to you. And it will happen, because it always does happen. That's how these markets finish. Now, you're going to help, certainly me, and Rita here, if you can send in any questions or ask for any charts to look at, and any questions at all on these charts. Rita said we got some, and she's very good at reading them out and looking at them.
A couple of questions. One's from Bruce. Bruce says, does professional money trade on order flow volume only, or do they use charts? If they don't use charts, then how do they recognize support and resistance areas over, say, many years?
Well, the real top professional people, they got all that in their mind. You know, we may think, oh, you need a chart or something to see this, but they don't. I don't know whether you've ever played bridge or not, but if you play bridge with some of the top people, they remember hands they had a year ago. And they say, oh yes, you had the king and the queen was here and so on and so on. They remember it. And professional money, with all that money involved, don't worry, they know where the support resistance is. They know exactly what's going on. It's a good idea, if you can, read those newsletters. Because on one newsletter I mentioned that if you're a professional trader, one of your skills is to understand what you do, how it will affect the herd. Very interesting to read that.
Winston's asking, how should we treat a bearish volume bar with a bullish spread bar? Do you get that? Do you understand what that means?
What was it, Rita?
How should we treat a bearish volume bar with a bullish spread bar?
Well, can it be both? Or are you talking about two separate bars?
Ask Winston to clarify that for us then.
Rephrase.
Ask him, you've got the speaker.
Yeah.
Hi, could you clarify that or rephrase that, Winston, because we're not quite sure what you mean by that. Colin is saying, Tom, you have commented on the end of a rising market, and the sentiment seems to be the end is near. However, you have also said a trend will continue for much longer than one would possibly expect. Can you comment, please?
Well, part of your skill as a chart reader and a trader, you anticipating what could happen, right? And at the moment, we don't have an end of a rising market. We don't have a buying climax. And it is persistently going up. The market's very, very crafty, very cunning, and I must say very devious. And that's why trends will appear to run longer than your gut feeling or how you feel it should. You say, oh no, it can't go any higher. But it suddenly does. It's very misleading. But what will stop it will be a buying climax, which we haven't seen yet, or an end of a rising market, which we haven't seen yet. But don't worry, when I see it, or we see it, you'll all know. It'll be here Friday at 5:30. It'll also be the newsletters. And Gavin will be, by the way, Gavin's had a very good time. He's in Poland at the moment. Apparently he went long on the S&P 500, made a lot of money in front of an audience, which is always very satisfying. It's not easy trading in front of a crowd because you tend to naturally want to pick out a trade, and you may tend to force yourself, and it may not truly be there, but he's very good at that, Gavin, very good.
Dollar currency, future. Carlos, would you mean the dollar against what? When you say put up the dollar currency? We'll do cable then. The dollar in the futures market. Well then, we don't have that day. Okay. Unless, do you know the code, Carlos? But he also said the euro, if not. So we've got that, haven't we? 6E, isn't it? Yeah. Daily.
This is the euro against the dollar. While we could potentially have a setup for an up move, potentially, but I can't really see it yet. There's the stopping volume, I assume. It's a red down bar, look. The spread has narrowed. There's two red down bars. There's one here, look. And the volume is high. That means that there was a lot of activity taking place at that moment on that bar. On that activity, the market drifted up, look. If it's really bullish, it usually drifts up faster than that. Now, we're not worried too much about these red arrows. What we really want to see, or would like to see, was this red down bar come lower. Now, the volume is a lot lower than here, look. Now, when you see this dip down, there's the line, look. It's dipped back down into this area where you had this high activity, high volume. And when it, in the future, when it dips back down here, I'd like to see it going a bit lower, and the volume is low, that means that there must have been buying here, look, for it to close off the low, narrow spread, and to actually go up like that. And to come down, and there's no volume now, means there's no selling pressure. And that must mean that demand must be greater than supply. I'd like to have seen it come down here. It is a sort of setup. It's not perfect setup as far as I'm concerned. We've gone up 2 bars. I'd like to have seen that come lower. And if I'd seen that come lower and the volume was like that, I would have said, right, let's go long. That's one of the setups that we look for. That's one of the automatic setups that we hope the computer will identify for you automatically.
Okay, Winston, who said, how should we treat a bearish volume bar with a bullish spread bar, and clarified it with the volume bar is red, bearish, the spread bar is green, bullish. We were hoping that maybe Winston... Okay, then he says, can an up bar be bullish or bearish, providing it's higher than the bar behind? If you could give us an example of a chart, and give us an example of what you mean, that would be better, because Tom needs to see a picture, basically, to understand. We're not understanding the question, but if you can see a chart, that would be good. So give us a chart, that you know of, or if you see one come up as we're talking, then point it out to us. Okay, Jerry is saying this, Tom. When you see a high volume up bar breaking through a significant support or resistance line with strength in the background, it looks like absorption volume. However, sometimes it also appears like the start of distribution, and the S redirect does not hold. I am seeing this on the euro dollar at this moment on the 5-minute chart. Shall we put that one up, Pete? As high volume is needed to break through a support and resistance line caused by a very high volume bar way in the background. What looked like a breakout on absorptive volume may actually be the start of distribution if the support and resistance does not hold. Tom?
Well, the thing is, on that particular chart that we're looking at now, markets do not like ultra-high volume on up bars, especially when you've got a bull move behind you, because that means that the professional money are selling. There's a lot of activity going on, creating high volume, right? It's going up into fresh high ground. That's selling. And you'll always see it all the time. And that's the reason why it's come off like this. It's because of this. That volume there and that activity there is the reason why this market fell off to here. And it's probably going up on no demand. It will come lower. That is weakness. Now, with currency trading, you need to specialize in it. Get your head around it, how they behave and what they do. Ignore the signals at your peril, which I tell Gavin. And your skill as a trader will kick in. Now, of course, these various signals, some work better, admittedly, in a bull market, and some work better in a bear market. But we're actually, if this is a currency, which it is, look, but whenever you see that, you know that there's weakness there, and that's going to knock that back. At the very, very best, it's going to go sideways. And if they're really bullish, they'll start testing, but they're not. And that's why it's fallen off, look. Markets don't like ultra-high volume on up bars. Especially when it's up at a recent fresh high ground, especially when it closes well down in the middle, and especially after an up move. And with that high volume, that's got to be selling. It can't be anything else. And then notice this next bar, they mark that up, look, and that's no demand. Even the dumb computer tells you, look, no demand. All it is looking at the code that we instructed the programmers to put in there. And so the computer's saying, right, okay, no emotions, no news, nothing, that's it. It must be no demand. So you've got weakness there. Supply is screaming out loud at you. No demand is reassuring you it is. There'll be no demand on this bar. That's very low volume, is it? Has to be. Right, and then it marked down, look. You've got a green arrow here, admittedly, but the next bar will be no demand. A little bit of support's come in. In these kind of occasions, it's if you want to know where we call this an automatic rally. It's a bouncing effect you get from a falling market. Do a 50% retracement. That is from the high to the low. Get some idea where it's going. That's the only mathematical indications that I ever use. 50% retracement seems to work. Now, is that clear? That's very, very clear on that chart, look. You're going to see this hundreds of times in the future. Exactly that, look. Hundreds of times in your lifetime. You're going to see a bull move, right, up into fresh high ground, high volume, closing in the middle, look. And also the very next bar is interesting. It's saying, well, look, okay, if you don't believe me the first time, here's a no demand up bar, look. That means the professional money certainly saw the weakness. And as it was marked up, which they do, right, like an auctioneer, marking up goods, trying to get as much as he can, right, the professional side is saying, no, thank you. I'm not going long on this. I'm not interested at all. And that's why you get no demand up moves in a weak market. And that one's confirming the very, very next bar, look. You can make money on these for scalping.
I'm sitting here in a quandary and I'm still trying to work out what Winston means. But when you say can an up bar be bullish or bearish providing it's higher than the bar behind you, well, I'm not sure what you mean, but an up bar can be either bullish or bearish. If you look at something like, it all depends on where it is in the chart. It depends on the volume as well and the spread. So as Tom said, this bar, this is an up bar. That's a bearish bar in this particular chart. It's gone up and the volume is extremely high. So it's closed in the middle. So it's a fairly bearish bar. Then you've got this. That's an up bar. That's a bearish bar because the volume is very low after this particular weakness. And the same here. If you got something like this, that might be a bullish bar if it was pushing up through a previous area of all this. Or yeah, my husband's saying this is a, let's put up more. If it's pushing up, yeah, so through a previous area of resistance, we've got an area here. So it's pushed up. So that could be a bullish bar if that was at that time, if that was the case. So I don't know if I've answered that. But I was in a quandary as to what Winston, that bar is pushing up a previous area. Yes, says Jerry, he's noticed. So that might be an example of an up bar that is bullish. Yeah, we're sort of, Tom, we're just sort of pretending because he's trying to say, he's asking if there are, we're struggling, yeah. Do you want to speak, Peter?
Yeah, we were slightly struggling just to say about that because when weakness appears, it tends to appear on up bars. And when strength appears, it tends to appear on down bars. And that's tending to, so it's not exactly that, but it's tending to. So there are occasions when there are up bars that are a sign of strength. It might be a bottom reversal, if you know what that is. That's where a down move has come to an end, the volume's come in, and the next bar is up. And the next bar is up to the extent that it closes near the top of the previous bar, or even past it, that would be an up bar. It would also be part of a bottom reversal. Again, I can refer you to Tom's book, The Undeclared Secrets That Drive the Stock Market, where that, among other many principles, are described. So it's worth getting that, just to read that and reread it, so that you get the idea. And of course, there are charts in the book illustrating that. So I hope that's clarified it, rather than confused.
DDD daily chart,
please. DDD is being requested for Pete. Hang on. So I must admit, I don't know what DDD is. Is it a stock or something else? Perhaps you could type it in, Pete. Tom.
Well, DDD, obviously a stock.
It's 3D Systems, maker of 3D printers.
Oh, right. Oh, well, don't forget that very often when you see a chart like this, you go to the directors themselves and say, look, why has your stock fallen the last few days? And they look at you blank, shrug their shoulders, and say, we got no idea. The company was just the same now as it was 2 weeks ago. So it just shows you that it's the professional money manipulating the price in the background, right? Because they're doing it for profit. They're not doing it for anything else. They're not worried about the company themselves. But this one here's got a sign of weakness, look. And whenever you see that, look, that is a sign of weakness. Supply coming in. It's similar to that first bar we looked at, that we described as an upthrust. Whenever you see that and you're long, you want to really get out of there, because you can always buy it back. Just come off those bars, look. I never like these red down bars on this increase in volume like this. Although admittedly we've got a green arrow there. Computer thinks there must be a bit of buying in there, and you may get some sort of rally, but that weakness up there is there. It's there, imprinted, and that's it. So that will not move, that will not go away. So there's a reason for that, a reason that you'll never find out. That's, I suppose, what they call inside information. Now, what's interesting with this chart reading is that we can trade on inside information, because the inside information is coming out in a chart form. Remember, a chart is a language speaking to you. All these different time frames, and it's written in a high, low, close, and volume, like Braille. And as you go through the experience of learning this, you will see that what I tell you is in fact true, and you will never regret it. Keep plugging away at it, and you'll have that with you for the rest of your life. You'll never ever regret doing it, I can assure you.
So we've got a request for the S&P Future, that is ES, weekly. Who's asked for that?
Yeah, that's there.
Peter.
Oh, there was okay. We'll have to go back. Chris has come up with a question on that other chart. Shall we go back to it now, or we'll go back? So Chris is asking, where would be a good short entry for this stock? Below an upthrust bar?
Well, I personally, people have different styles. I mean, as soon as I see it, I short it. I don't mess around trying to be too clever. That's weakness in anybody's language. You just go in short. you get different stories from different people, but that's what they're doing, is they're homing in on their personal skill as a trader, which is another leap forward. You can read these charts, but you've got to trade it. And to be a trader, a good trader, you have to have the ability to move in the market, out of the market, and know what on earth the hell's going on and how it's going to affect you. But I personally don't waste time. I see that, I go short. Where I've heard even Gavin saying, oh, well, I like to do this and that and all those, when this hits the middle of the close or the high and all this stuff. I can't be bothered with all that. Weakness is weakness as far as I'm concerned.
Okay, so for Peter, in October 2007, can we bring up to, or we, yeah. Yeah. In October 2007, as the SPX started its bearish move down, there were no volume peaks. The volume was nearly the same like last week. Shall we now expect big volume bars for a market turn down?
You would definitely expect to see big volume come in if we're going to turn this market into a bear market. But we haven't seen that yet. That's what I was saying. You sitting here on the sideline watching this, and you're going to be misled. Because if you're a human being, you can't help absorbing all the news and everything, and you can't help really formulate an opinion of your own. And whatever that opinion is, it's almost guaranteed to be wrong. And that's how it seems to work. Now, why that is, I'm not quite sure. I'll have to put some thought into that one day and try to figure it out. But it does appear to be that way. But when you see a setup, right, the only way I know is to go in and trade it. And we're doing our best. We have this Russian programmer who's very, very good. And hopefully he's going to pick out these setups in a far more accurate way for you, or even for us. Because the main problem with trading is that even if you recognize the so-called setups, you've got to find them. And if you've got thousands of charts, that's now impossible. The computer seems to be able to do it in seconds. Any other questions?
Peter, do you want to say something on that now?
Yeah, I say something. It's really Tom, in a way. Yeah, so Peter was saying that back at the beginning of an apparent bear move, back in 2007, October if you like, he's saying there's no obvious, although the computer spotted it, there's no obvious sign of high volume around. Is that what you're saying, Peter? I think it is. So that's why he was asking, well, should we actually be looking for high volume now? So one could argue, if you looked in general at that period of time, there was high volume around, although it wasn't right at the peak. But it's not clear. Tom, have you got any comments on that?
Well, it may not be obvious to us, but you can bet your bottom dollar it's in there somewhere. Because that rounding over like that peak appearance is definitely distribution. Now, they're crafty. They every wave up, they sell. on their selling, it causes the market to fall. They support the market. They may even rebuy some back to hold it up. But the volume will be in there somewhere. But it may not be all that obvious at times. Now we know it was distribution because of the fall afterwards. You don't get a fall like that unless that was distribution. So it's in there, and there is a few peaks there that look high to me. Well, very often Peter says a monthly. It's quite right. Yeah. So what the hell have we got now?
So the 31st of August, in other words, the end of August, there was a high volume up bar. So some volume certainly came in. It's just made that small top.
I mean, it's
Stand by, folks. I've made the chart easier for Tom to see, but I've got to find the exact date again. Right, so if you're looking at the monthly chart, I mean, there is some high volume around. Tom? Is there? So this was the top.
it'll be there somewhere.
It was high volume.
Oh, there's high volume there, look. Right there, look. It's an up bar. And when it got signals, these signals don't appear.
That says test. This one here saying a test is obviously looking at the tail, isn't it?
What's these red ones at the top?
Red one saying
Here.
trap up.
You know, if a computer comes up with a signal, there must be some data in there that's causing that. But even though it may not be all that obvious in this case, the volume has to be there because that we know in hindsight that's distribution. And again, it is an up bar, looks high volume, and this especially looks like an up thrust type bar here, weakness. But gradually you keep plugging away at it. And if it's not all that obvious, turn the page. There's plenty of other charts to look at.
Can we see the top with volume on the daily? Why did you go to the monthly rather than the daily? Okay, question. Can we see the top with volume on the daily? Why did you go to the monthly rather than the daily? Yeah, you speak.
So the question was, why did we go to the monthly? Well, it's because we were looking around for an area of high volume, and it may not necessarily jump into your lap and appear right at the top on a daily bar or an hourly bar. As someone pointed out earlier, it could even possibly appear on a 4-hour chart. So, as Tom always says, if it's not immediately obvious, of course, turn the page, but at the same time, if it's not immediately obvious, you could look around, look at different time frames. So, for example, if a chart is not clear, you might just change the time frame because something just may show up on a different time frame. Rita?
Winston is says, to help simplify my question, this was about bullish and bearish bars. I usually consider a bullish bar to be an up bar and a bearish bar to be a down bar, but I am understanding that an up and down bar has to do with the spread and close of the bar in relation to the bar behind it. I simply want to clarify what is an up bar in the VSA methodology. And that up bar is a bar that closes higher than the bar before it. So any of those blue bars that you see on Tom's chart here, they are up bars, and definitely not up bar is not bullish and down bar is not bearish. It's all to do with the position of the bar on the chart, the volume and the spread. That's why it's called VSA, volume spread analysis, and you can learn all about that in Tom's book, The Undeclared Secrets That Drive the Stock Market, and that's where I learnt it all. I had to sit there and I drew every single bar and learnt them from that book, and I read it 3 times until I could then look at a chart and immediately see what was bullish and bearish. So put some study into it. Like everything, I suppose, once you've got it, it's pretty simple, but you've got to learn it first. It does take time. Yeah, as my husband's saying, he's chirping away in the background. Yeah, he's saying it does take time. Do your own study. That's what I found was so valuable to me, because I could do it in my own at my own speed and come on the seminars, on the webinars, because I found also that different speakers I could relate to certain people rather than others. So when I was fairly new to VSA, you know, I've actually personally found Tom easier to understand, because he keeps it simple, and he doesn't talk too fast. So that's it. The 2 things together. Edmund says, a question for me or Peter: how do you build up your skill as a trader, i.e. ability to act when you see a setup? Peter, do you want to answer that?
The simplest advice is to wait for the VSA principle to appear. Not, in other words, expecting to be able to read the chart at any moment and just jump in because you think you know the direction. You have to see the principle. And when you see the principle, whether it be a sign of strength or weakness, then that's the time to go for it. And my own learning was along the lines of being impatient, and you know, I don't want to sit here for 3 hours waiting for an opportunity. I want to get in now in case I miss the move. This was my thinking earlier on, and I learnt the hard way is to wait for the principle and go in on the principle rather than risk it by, you know, you've missed the principle 2 hours ago or 2 bars ago. You've got to get in on the principle. And the principle may be a simple VSA principle like strength appearing on a down bar, closing in the middle, say, after a down move. Or you could go for, probably the safer option by far is to go for what we call a setup, which is a couple of principles together, or even 3 principles together. Gavin, actually, if you look at his seminars or watch his seminars, he's quite good at doing that. He likes to be super sure to some extent. He likes to see a setup, in other words, a sign of strength, perhaps followed by a test, which if you look at his seminars or listen to Tom, you'll see that tests after strength do come along. But not always, of course. But there you are, that's the way it is. Sometimes strength comes in and the market shoots up, and if you've been waiting for a setup which would have involved a test of that strength, then you've missed out because the market shot up. However, if you want to be safe, which is probably the best way of doing it, wait for the setup.
Edmund's asking, say if you get in on a test bar and the next bar closes lower, do you get out or do you stay in the trade until it hits your stop? Well, if I got in on a test bar and the next bar was down, that then calls it a failed test. Get out. But Tom, I mean, if the volume is even lower, it's possible that it's not, but I'd be careful there. So probably wouldn't wait for it to hit me stop. Muir is asking, Tom, what is the reason the open is not part of your analysis?
Right, why don't we ever use the open? Right. Imagine you're a private detective. Opening the market, I assume, or bar. But imagine you're a private detective and you've got your report pad there and your pen, and you've got your eye on who you're supposed to be tracking. Now, you don't pay particularly attention to the moment he wakes up, kicks his legs over the side of the bed and gets up, which is the opening. Why? Because nothing's happened. It's only important if you're using or locked in on these mathematical formulas, which I personally don't believe in. Now, I've told many people, even on these seminars, my opinion of these formulas is that they don't work because there's too many clever people out there with money, backed with money. And if there was a formula out there that say, look, when this happens and that happens, mathematically, it's going to go up or it's going to go down, they would have seen that many moons ago. And the fact is, as soon as it started to appear, they would be in on the trade, and their trade would dilute the formula, so it wouldn't be there in the first place. It wouldn't be there in hindsight to look at, because it would be traded out of existence. That's my opinion of formulas. And the open, right, is what they use. So they've got to have something to tag onto with these mathematical formulas. What was the price it opened? But we're not interested in that. Let's see what's happening. That's why we don't use it.
Talking of mathematical formulas, Tom will remind me and us, wasn't there some years ago a formula created by somebody, I don't know who, called Black-Scholes? Oh, yes. This was a formula that appeared to work, and I think I never checked it out fully, but it actually worked. The trouble was, after a while, people caught on and traded it, and therefore it stopped working. So as Tom says, if it was a goer, it was a good formula, then as soon as it's noticed, it's going to be traded, and therefore, of course, it loses its value completely.
Tom, do you want to say something about that?
Well, the Black-Scholes formula, there's a fantastic videotape on it. I don't know whether you could find it on the search on the internet, but it's about the Scholes formula, and it really worked very well to start with. But then something went wrong. The Russians stopped paying their payments or something, or the wheat collapse or something, and the whole lot turned sour. And certain funds lost a lot, billions, lost a lot of money. But it's there. It's well worth looking at. But that's the basis of a mathematical formula.
Carlos says, is that no demand signal accurate there, Tom? Can you see that? Well, you'll soon find out, I suppose. The next bar's closed level. Do you want to speak, Tom?
Well, all the no demands are accurate. What you mean is it accurate enough to make the market fall? Well, we don't know that. But we know that they've pushed up through here, look. It's the S&P 500, is it? 1 hour chart. Widespread up, pushes it up. It's Friday. They'd like to mark the market up as much as possible. Does that mean no demand here, which is quite normal? Close the middle while they is that a down bar or an up bar?
That's a middle. It's a close in the middle. It's level. Sitting right.
Oh, well, there's no selling pressure. So that actually is not no demand. That shows there's no selling pressure. I mean, widespread up. Look, 2 bars. There's the volume. Now, that could be a test. And that means that there's no selling pressure. In other words, don't worry. If this was weakness, you wouldn't see this. You'd see heavy volume probably going up. Or clearly no demand. It's not going up. It's a level bar. It's very important. No demand appears on the up bar. And they will mark it up deliberately if they think the market's weak. But that's not an up bar.
I'm just saying, it's a matter of interest. If I see that, I can't take a trade at that point because it's not clear at all. It's just part of what's unfolding.
Yes, you have to see what the market actually does on that particular bar. I would want to see a change in direction first, and then I'd look for a no demand bar to confirm it if it was weak. But Colin's saying that black bar on his chart is a sign of strength 29 test. So Tom says he believes that. Carlos says, I can understand why the computer makes it like that, because it's comparing the volume on the previous bar, but that seems a good amount of volume. The level bar looks more like a real no demand to me. It's difficult to tell. As Peter says, if it's not clear, stay away. Yeah, or keep an eye on it, see what happens. But I wouldn't trade on that. Tom says, you don't make a trade unless it's obvious. Bruce is asking, on a chart there might be, say, 2,000 contracts traded in one bar on any time frame, and it appears that professional money has entered the market. However, sometime later there may be many thousands of contracts that totally dwarf the 2,000 contracts. How do you recognize volatility caused by the major professional groups and not that generated by a small syndicate?
Well, you can't identify it too much, but you can see the overall picture laid before you. And there are various groups there. You're right. Some do 2,000 contracts, some do 50,000. Usually you have to watch the volume. And on that volume or activity, what did the market actually do? This market, to me, looks like it wants to go up. It's Friday. They love to mark it up. Finish up on a high Friday. All the media will get all the good news, the newspapers and all the rest of it. Because what they want now is people rushing in buying. Take this up as a new dizzy high ground. And they can start selling to them. That's how it works.
Okay, our last one, Peter, can you put PXD in? It's on the New York Stock Exchange. What is it, Edmund, PXD? Do you know? Okay, Tom, could you... Oh, it's natural resource, he says.
Well, as soon as I look at this chart measure, I think, God, that's weak. I wouldn't want to touch that. I mean, look, you've got fantastic here. Got weakness all up here, look. Right, you've got this up thrust, look. Right. And then bang, down. That's weak. And that's weak because in the background it's weak. You may get a little bit of support. It looks like there's something happened here. Right. But as you see, admittedly, there's a little bit, seems to be a little support here. Right. It may drift up a little bit, but certainly the trouble with this stock is you've got this inherent weakness in the background. You've got this upthrust, you've got this climactic action away to the back. That's certainly not the stock I'd be interested in at all. I keep well away from that personally.
Should we do one more? Okay, very quickly, one more. Tom, you would need to look 3 months back to see support on that chart. Yeah. Do you want to speak there, Tom? Tom's saying that's definitely distribution there. So yes, there was support, but that's definitely distribution. Okay. Crude oil, Peter, for Carlos. It seems to be under accumulation, he says. Tom, do you agree?
No, it's not the thing I follow very closely, but first glance, you could be right. I mean, first of all, is there any stopping volume here? First of all, is there a down move, which it does appear to be, right? Now, where is the stopping volume? Is it there? Can you see it, Rita? Not all that obvious. Yeah, no, we want it down here. We want to see stopping volume. So we haven't seen that. Where is that? So it's kind of drifting sideways. Before you saw a bull move in this, you would need to see these down moves here finish up with high volume, narrow spreads. Then it goes sideways. Then it tests like this. And then on these down bars, you would expect to see low volume. And is it low volume? Not really, is it? That's not a good stock to be long on. It may go up a little bit, yes. But to me, well, that's not accumulation. That's probably weakness all through there. Anyway, I think we're going to pack up now, and thank you very, very much for listening. We'll be doing the newsletter what day?
Probably Sunday.
Probably Sunday, right. We do a newsletter this week, Sunday. It's always worth looking at. And if you've got any thing you're not quite sure about, if you let us know, we could even include it in the newsletter, discuss it, like by writing about it at the tail end of the newsletter. Like we have stopping volume and that we have pushing through supply to the left, things like that. And we enjoy doing it. So please help us to enjoy ourselves. And don't worry if you don't get it straight away. Lots of people seem to have to look at this for 2 or 3 years before they start seeing the light. But even clever people like programmers. I've had loads of programmers. They couldn't see it. I've had 8 programmers here over the years. These are guys from university, very clever guys. And yet they just don't understand what you're talking about. So don't be annoyed at yourself. But it's there. And the reason I think it's people have trouble, they're too clever. Like I told Peter here, I say, don't be too clever. Think simple. Think of the supply and demand situation. It's true, though. I'll say goodbye.
Okay, thanks, folks. Yeah, my wife said that when Tom said, Peter, don't be too clever, she said that wouldn't be too hard for you, Peter. So with that, we'll see you all next week. Thank you for coming, and we'll hope you have a good weekend.